We are now live, so hello and welcome to those of you joining us just a few minutes early. My name is Charlotte. I'll be your Money Show host for this session. I do have Sam Stovall here with me in the Zoom room, and he's ready to begin his presentation on time at 2:10 p.m. That is Eastern Time, coming up in just a few short minutes. Thank you all so much for your patience, and I hope you are enjoying the show so far. Welcome in to those of you just joining us. We just have a couple of minutes to go here before the next presentation begins on time at 2:10 p.m. Eastern Time. Thank you all so much for joining us, and thank you for your patience. To those of you just tuning in, if you're looking for something to do while you wait, we do have some more information on CFRA research in their virtual booth below the video player. You can add some of those downloads to your briefcase if you're interested in checking out some more information. Hello, everyone, and welcome to the session. I am pleased to introduce Sam Stovall, Chief Investment Strategist at CFRA Research, where he serves as analyst, publisher, and communicator of CFRA's outlook for the economy, market, and sectors. Now, Sam is also the author of the seven rules of Wall Street, and he writes Weekly Sector Watch and the lead for CFRA's flagship newsletter, The Outlook. Now, to our live viewers, Sam has a lot of information to share with us today, but if you do have questions, please feel free to share them in the live chat box. That's located on the right-hand side of your browser there next to the video player. Time permitting, we'll see if we can get to any of those at the end. And with that all said, Sam, I will hand the mic over to you. I'll be here if you need me, but the floor is all yours.
Wonderful. Thank you, Charlotte. Thanks, everybody, for tuning in. I hope this will be a worthwhile time that you will be spending with me this afternoon. Basically, I'm talking about our second half investment outlook, which we're basically titling Trust the Trend. In terms of a summary of what I'm going to be talking about and data that I will be sharing with you, we have maintained our S&P 500 target of 7730. The market bias does remain to the upside even though at least the cap-weighted S&P 500 has been treading water since establishing its 24th new all-time high on June 2nd. Now, treading water since the end of Q1 earnings is not really a surprise because investors are waiting for the next series of catalysts to push share prices one way or the other. Of course, the concerns recently have been the reignition of tensions between the US and Iran. That has pushed oil prices up in the near term. Next week, we will be getting elevated CPI and PPI inflation readings, but the real question is whether those kind of advances are likely to be maintained or should again start to ease as the year progresses. Also, we have a new Fed chair, and it seems as if that Fed chair is less willing to offer as much guidance through dot plots and other mechanisms as his predecessor. So, in a sense, we have a lot to evaluate over the next several weeks and months. I do think, however, that even though the market is likely to work its way higher through the end of this year, a digestion of recent gains is not out of the question. Nearly 50% of all second halves of midterm election years saw declines of 5% or more. Quite frankly, I would be pleased if we did see a bit of a resetting of the dials. Also being reminded that it has taken the S&P only 1.5 months on average to get back from declines of up to 10%. Also, our second half outlook remains positive because historically an elevated new high count has led to a positive full year performance. By that, I mean that the 24 that we have experienced so far this year puts us in the top 20 of all years going back to World War II, and an elevated new high count has contributed to a very strong reading for the entire year. Also, first half of the year being positive also will likely add to the potential of the second half being positive. For all years, the second half gained in price about 70% of the time. However, following an advance in the first half, that momentum carried through and the market was higher 77% of the time in the second half since World War II. And if that first half was higher by 5% or more, remember this time around we were up by more than 9%, then the frequency of advance jumps to a little more than 85%. So not a guarantee, but certainly a comforting statistic. Also, we have had recently above average sub-industry breadth. What I mean by that is I monitor the 153 sub-industries in the S&P 1500 index. These 153, I measure how many of them are above their 50 and 200-day moving averages. And with that number being above the average going back in time to the mid-1990s, whenever that average has been above average at the end of the first half, the market was higher 100% of the time in the second half. Again, not a guarantee, but a very comforting statistic. We also have earnings coming out. Second quarter earnings are expected to be up by nearly 21%, followed by a 22% gain in the third quarter and a 23% advance in the fourth quarter. And today, the market is trading at a multiple of 21 times, which is below the December 31, 2025 PE of 23 times. So despite the advance in the market, we are trading at a more attractive valuation level. We do think that GDP growth will remain around that 2% level for 2026 and 2027. And we do believe that inflation readings will continue to moderate over the next several quarters. The market does expect a rate hike by the end of the year. We're still out. We still don't think that that is the most likely scenario, especially since we got the weaker than expected employment data most recently. But the US dollar has been on the ascent, which does tend to be beneficial to mid and small caps. to domestic stocks relative to international shares. And it also is positive for financials because it does usually tend to steepen the yield curve. Now, we certainly know that midterm election years are the most challenging year within the 4-year presidential cycle since World War II. I've shaded in blue year 2, and as you can see, the full year has gained on average less than 4% and rose in price 55% of the time, and the average intra-year drawdown has been 18%. Yet the second quarter was not down 2.6%, was actually up quite nicely. So the question remains, gee, what was it that caused the market to do so well? And is that something that is likely to continue into Q3? Q4 typically does do fairly well, primarily because the uncertainty surrounding midterm elections has been lifted. And so that does put us into a very nice 12-month performance from the end of October through the end of October of the following year. What we saw in the first half was a pretty strong results. We had the S&P 500 up 7.5%. Small caps trounced large caps up nearly 20%. Mid caps were up about 14.5%. And really communication services, financials, discretionary, the only ones that were in negative territory. So a pretty good return on a sector and a benchmark basis. 65% of the 153 sub-industries in the S&P 500 posted advances, many of them coming from technology or the industrials category. So what really was the driver? Well, primarily it was the much better than expected earnings growth relative to projections at the end of each quarter. Right now, we are waiting on second quarter earnings, which are currently expected to be 20.9%. That's the green shaded column. But compare that with what the forecast was on December 31st for the overall market, up 14% versus what is now likely to be a 21% advance. We saw technology now up 61% for the forecast for the second quarter versus its earlier estimate of 33.4%. Energy also did well, but that was because of the concerns with Iran, et cetera. So you can see that many of the sectors have seen upward bumps to their Q2 earnings estimates. We also saw the same for Q3. Instead of a 12.1% gain anticipated for the market as of December 31st, add 10 percentage points, and that's where we stand right now. For the full year, up nearly 23% in earnings for the S&P 500 versus a little more than 14% expected at the end of last year. And then 2027 estimates have also risen quite nicely to a little more than 18%, so up 300 basis points plus since the December 31st estimate of 14.7%. So this is primarily the reason, in my opinion, why the market took off and did so well in the second quarter, and then posting a very nice return in the first half. When you look at valuations, and this shows the 11 sectors in the S&P 500, as well as the 500 itself, what is the 2026 earnings estimate, then shows, depending on how far you want to go back in time, what is the absolute next 12-month NTM PE ratio. Well, the average over the last 20 years has been 17.2 for the market. Well, we're at 21.3, so we're trading at a 24% premium. But if you look over a 10-year basis, we're at an 8% premium. 5-year basis, we're at a 3% premium. Take a look at technology, which is pretty interesting. We're looking for very strong earnings growth for all of 2026. The PE on forward estimates now about 23 times versus a 19.5 average over the last 20 years. So we are trading at a 17% premium. But if you follow the argument that really AI over the last 5 to 10 years has been driving earnings in technology. Well, actually, on a 10-year comparative basis, we're trading at a 3% discount to the normal average PE ratio. And on a 5-year basis, we're trading at a 14% discount. So you could also look at on a relative basis versus the overall market, depending on which time frame you want to embrace. We're looking at a 5, 10, or nearly 20% discount relative to the overall market. So one could say that we are not dealing with valuations that are comparative with 2000 by any stretch. And it's mainly because we've actually seen very strong earnings growth take place. This is a chart showing on a weekly basis what percent of those 153 sub-industries in the S&P 1500 are trading above their 50 and 200-day moving averages. So at the end of June, 49% of them were trading above both averages. And interestingly enough, the statistic I mentioned before was that whenever that happened over the last 30 years, the market was higher in the second half 100% of the time and gained in price nearly 9% in that second half. You also see in red that sometimes this indicator can be helpful in deciding whether investors have thrown the baby out with the bathwater, meaning that if we end up with a very small number of sub-industries trading above 50 and 200-day moving averages, we've basically gone too far to the downside. It almost picked the exact bottom on April 4th of 2025 after we had a 19% decline, and then we saw a very sharp turnaround thereafter. On a March 30th of this year, we did not eclipse that 10% threshold, which is usually the yellow light, and the red light being at a 5% threshold, but it certainly came close, indicating that it was likely to be only a pullback, and meaning a decline of 5 to 10% and nothing worse. But what's interesting is when you look at beneath the surface, it was not just technology that's really driving this market. I'm shading in green those sectors that actually had the greatest percentage of sub-industries within them trading above their 50 and 200-day moving averages. Financials, healthcare, industrials are the three leading sectors and are the ones that are also doing quite well during this most recent rotation that we have seen in the marketplace. However, communication services, energy, and materials were the ones that were taking it on the chin, if you will, and did not have great participation across the board. But as I mentioned a couple of times, by looking at the participation or the breadth, if you will, what percent of those 153 sub-industries trading above both 50 and 200-day moving averages in these years, going back 30 years, because that's as far back as S&P has sector and sub-industry level data on the S&P 1500 level. Whenever we were above average at the end of June, the market continued to rise in that second half, 100% of the time, advancing nearly 9%. So again, past performance is no guarantee of future results, but it can sort of calm investors' nerves to indicate that, yeah, maybe the second half will be good because the first half did so well. But let me remind you that we could stumble a little bit in this third quarter. These are all midterm election year quarters going back to 1990. And you can see that on average, the second quarter has declined 3.2%, with 9 of the 11 sectors posting declines. In the third quarter, the average sell-off for the S&P was 2.2%, with only one sector in positive territory. Well, the second quarter certainly bucked that trend, as I mentioned, advancing quite nicely, nearly a double-digit gain, mainly because of the better-than-expected earnings numbers. Well, what about Q3? Well, if we're already expecting a 21% year-on-year rise, in Q2 earnings that are beginning to be reported now, that bar is set pretty high. And also, if you consider the fact that the tensions with Iran have resumed, then certainly guidance might be a bit shaky, because who knows how long this is going to last? Who knows what kind of an impact a resurgence in oil prices will have on inflationary readings, and the likelihood that the next Fed move will be higher rather than lower. We think it'll end up not being a rate hike by the end of this year, and maybe we look at a rate cut again sometime in 2027. So we do think that Q4 will end up repeating its typical positive performance, with 10 of 11 sectors posting positive returns in the fourth quarter of midterm election years, and the market itself doing quite nicely. One reason is because we still have solid GDP and earnings growth expectations, not only for this year, but for next year as well, backed by our expectation for falling inflation and no rate hike to occur this year. So we do think that GDP will be growing by around 2%. Core PCE will be coming down from the recent average for this year of 3.3% down to 2.5%. Fed funds rate would also likely to ease a bit, ditto for the 10-year note. And we also think that oil prices will be averaging about $81 this year and then $63 next year. So typically, volatility is the name of the game in midterm election years. This is a chart going back to World War II that essentially says what has been the cumulative S&P 500 price return during midterm election years. The blue line is all years, all midterm election years since World War II. The orange line is what we call wave years, meaning those years in which the president and both houses of Congress were ruled by the same party, meaning there's a lot more at stake in terms of this upcoming midterm election. So you can see from the box up top, each of these midterm election years, what was the average annual or intra-year drawdown, the average being 18%, which is the highest for all years in the presidential cycle. But certainly there were times like 1954, 58, in which we did not have a major decline. 2014, we had a decline similar to what we have already experienced. So maybe this is all that we are going to get. But if not, well, then, as I had mentioned before, we tend to recover from at least pullbacks, meaning declines of 5 to 10% in an average of only a month and a half. And for corrections, meaning declines of up to 20%, the average time to recover all that was lost is only 4 months from the bottom of that correction to that full recovery level. What has happened going back in time during that October 31 through October 31 period, meaning basically at the end of the midterm election concern period, meaning just before the elections actually take place, October 31 of midterm election years through October 31 of the following year, the market has never declined. On a price basis, yes, we had something as low as a 3% 12-month return, but the average price change was a gain of 16% because we had a multiple of double-digit increases going back since World War II. If you look at it on a total return basis, actually the return was in excess of 20%. So if history is going to repeat, and obviously there's no guarantee that it will, we could also see a nice return take place from October 31 of this year through the same period of next year, because the uncertainty surrounding midterm elections will have been lifted. Specifically, when you go back to 1990, again, as far back as S&P 500 has sector level data, we find that all styles, all sizes, and all sectors posted average increases during this 12-month period from October 31 to October 31. And then you can see on the right-hand side that 96% of the current 124 S&P 500 sub-industries posted price advances in that 12-month period, with many of the technology groups holding up the best. So this is something that we could look forward to. So those people who have exposure to technology, just hold on and you might be rewarded for your patience. Giving you an idea of or a reason to check out CFRA's Market Scope Advisor platform. I will show you a site in a second that you can go to get a free trial. We do show fundamental and ETF portfolios, so equity portfolios or ETF portfolios. And I highlighted one that I have been managing since April of 1999. It's called the Industry Momentum Portfolio. And at the end of each month, it picks those sectors and sub-industries that have shown the highest trailing 12-month relative strength and holds them until they fall out of the top 30% universe of those with the highest momentum. Year to date, this portfolio is up 31.8% versus 11.2 for the S&P Equal Weight 500. On a 3-year basis, it is up 22.4% versus 15.8 for the market. And since inception, it has outpaced the market by about 400 basis points per year. Again, past performance is no guarantee of future results, but I'm happy to lift the curtain to show you which sectors, sub-industries, and stocks currently make up this portfolio. The portfolio selects sub-industries, but since there is not an equal number of sub-industries trading as ETFs, what I do is I select the stock that our analysts have the highest buy, hold, and sell recommendation on to serve as a proxy for that sub-industry. And as you can see, it's not just technology stocks that populate this group. In fact, 7 of 11 sectors in the S&P 500 are represented. So you can see the sector name on the far left side, the sub-industry names in alphabetical order, and then the ticker for the stock that serves as a proxy for this industry portfolio. What is the current CFRA stars? Like a movie or a restaurant review, 5 is best, 1 is worst. And then what was the price of this stock as of last night? So this is where you can go if you want to learn more about CFRA equity research. We also have a technical analysis arm called Lowry. But if you go to cfraresearch.com, as shown in the bottom right of this slide, you can learn more about what we have to offer and also take advantage of a free trial offer. So actually, Charlotte, it looks like I do have a little bit of time left. So if you have the ability to ask some questions, because I cannot see them since I'm in presentation mode, I'm going to leave it up in case people want to go back to particular slides that I can highlight in greater detail.
Fantastic, Sam. Thank you. And we do have a couple of questions here in the chat. This first question was from Eddie. It was towards the beginning of your session here, and it's possible, I think you may have covered this, but we'll just go over it again. He wants to know your outlook on semiconductors and memory chips for the rest of this year.
Sure, not a surprise for that question. Actually, earnings really are likely to be driving this group. When we think about what is expected for the second quarter, I mentioned 21% growth for the S&P 500, 35% growth for the S&P Growth Index, 61% growth for the S&P technology sector, and 140% growth for the semiconductor industry. We still do have positive outlooks on NVIDIA. And if you take a look at the upcoming Outlook lead, which will be published Friday evening on Market Scope Advisor, it will show NVIDIA as the largest stock with the highest stars ranking within semiconductors. But we still believe we have a long-term growth expectations for semiconductors. And if you look at the chart of the SOX, SOXX ETF, all it has done is move back to the 50-day moving average. So basically, anytime your advance exceeds your supply lines, to use a military term, you tend to have to stop and let the supply line catch up. So I think that's what's been happening now, is that essentially the semiconductor group got too far, too fast above its moving average, and has now consolidated a bit back to that 50-day moving average, which we think is a positive for the group.
Thank you, Sam. This next question here is from one of our longtime viewers, Go Bananas. He's asking for your thoughts on the 70% trading expectation of rate hike by the institutionals as of yesterday.
Well, that certainly is, I believe, why the dollar has been strengthening, because the higher interest rates are here in the U.S., the more attractive they look relative to overseas markets. And as a result, that's probably why we've been seeing a decline in international stocks for U.S. shareholders. Certainly, the prospect of rising rates is out there. But we do know that one reason why Kevin Warsh was selected by President Trump is because President Trump would like the Fed chair to be promoting a rate easing cycle. Another reason for rate easing would be the weaker than anticipated employment data that we got most recently, combined with the trend that had been showing up in terms of inflation and expected by ourselves and other investment strategy groups out there, that inflation would be coming down over time. So I really believe that the Fed will be taking sort of a wait and see approach, looking at more data between now and the September FOMC meeting, and we'll have to see what that data show. But right now, our belief is that we will not be seeing a rate hike, and that could end up triggering a nice advance in the fourth quarter of this year.
Thank you, Sam. And we'll take just a couple more questions here. This next one is from Charles. He's asking if there is a change in political party in the House of Representatives or the Senate, will this change the outlook?
It will, a change to either the House or the Senate probably will not change the outlook. And in fact, history says that you should expect some sort of a change, because we have seen that on average, the ruling party has lost 4 seats in the Senate and 33 seats in the House during midterm election years. And only 4 times has the majority been maintained. And that was under Truman, under Kennedy, under Carter, and one more, and under Johnson. And never has it been maintained under a Republican administration. Again, not a guarantee. But precedent basically says that chances are we will likely see one or both houses change hands. And I think that maybe that could end up causing oil prices to come back down again, because maybe Congress will have more of a say in what takes place from a trade perspective and a general statement of war. So we'll just have to wait and see. But I think certainly the uncertainty will have been lifted, and as a result of whatever the election outcome happens to be.
All right. Last question here is from Eric. He's asking, how often does CFRA recommend individual stocks?
CFRA, which the original name, the Center for Financial Research and Analysis, but since that's a mouthful, we just go by CFRA. We cover about 1,650 stocks around the world, and our analysts are evaluating these stocks on a daily basis. So we could be changing our buy, hold, and sell recommendations, but we don't really do so frequently because our outlook is a 12-month outlook. So we're not a trading firm, but more of a longer-term investment research firm.
Well, Sam, thank you so much for today's presentation and also for answering those audience questions. I know they appreciate it. As always, it's a pleasure having you on the show.
Thank you, Charlotte. Thanks, everybody,
Absolutely.
for listening.
And another big thank you to those of you who are tuned in from us at Money Show. Be sure to stay tuned. We do still have some more great sessions in store for you throughout the rest of today. And I hope everyone has a wonderful rest of your day. Take care.